do
actually a good
something
question.
like
Do you mind
that.
if I get into that a little bit deeper? Let's say the market went up for 10 days in a row, just as an example. And again, just as an example, because I want to give everybody actionable stuff. Let's say you're long 1,000 shares of the SPY, just as an example. And however you look at the market, you see it slowing down, or you think whatever's going on, you think, okay, this is cool. I want to lock this in. You mentioned hedging at the beginning of the call, and now we're bringing it up again now. 1,000 shares is 10 options contracts. Would it be 10 options contracts, or would it be part of that? Again, this is all for educational purposes, but what would your thought process be on that?
Again, that's where delta comes in, because delta is that probability measure, right? So if you pick an out of the money put, it would actually be more than 10 contracts. If you do a 50 delta, in order to be 100% hedged, if you find 50 delta puts, you would actually have to buy 20 of them to be 1-for-1 because of the nature of delta. It really depends on what percentage you want to be hedged. If you want to be fully delta neutral, which isn't always a good idea, right? If you're net bullish, but you're like a little bit nervous of a pullback, you might want to just be 20 or 30% hedged, in which case what you said makes sense. You would just buy 30 delta puts and just buy 10 of them.
I know a lot of traders that do that straight up with equities, where stocks are very strong and they're heavier on the long side, but they're also paying attention to which stocks are showing relative weakness. So just using round numbers, they'll be long 1,000 or short 300 of those weak stocks. So while these things top out, then they already have a short position on in the other direction in the stocks that already had relative weakness to the market.
Yeah, you're just basically doing a short-term trade as a hedge. And then you
Exactly.
take it off once the danger has passed, right?
Exactly. That comes a little timing. You got to be good at timing on that. But if you understand how to do that, it helps you hold trades longer that you might normally have gotten shaken out of or stopped out of because you were smart enough or had the knowledge to put that hedge on.
Absolutely. And as a broader portfolio too, you don't want to get shaken out of things. Absolutely. And that's how people manage their money all the time. And it's really effective, because even if the hedge doesn't work, then guess what? Your portfolio is going up. So
Right.
it's
I know,
kind
right?
of, that's essentially what's going on. So it's a good thing.